Welcome back to Small Caps. My name is Kerry Stevenson. And today, guys, I'm pretty excited because I'm bringing you something a little bit different. Now, Gareth Soloway is I guess he looks at the macro picture, but he's a trader as well. He's the president, CFO, and chief market strategist for inthemoneystocks.com. So go check it out, inthemoneystocks.com. Nice and easy to remember. So I've asked Gareth to come on today, all the way from Florida in the US. We might ask him a little bit about COVID over there. Oh, I said that wrong word. Gareth, good to see you. Really appreciate your time. You're one of the best, I guess, minds in the market when it comes to trading and looking at the macro trends. So that's what I want to focus on today for our investors out there. So before we get into that, first time you and I have had a chat on Small Caps, give us a little overview of who you are and how you got into what you're doing now in the trading markets.
Wonderful. Well, first, thank you for having me, Kerry. It's a pleasure to be here with you guys. So I started back getting interested in the markets back in kind of the late 90s. The dot-coms were big here in the US. It was a crazy time, kind of much like it is now with cryptocurrency. There's a lot of comparisons that can be drawn. And when I was younger, this was actually when I was in high school, I had no background in the market. My parents didn't invest. And I got into one of these investment clubs and you got a fake $100,000 to invest. And, being that time in the market, I all of a sudden was doubling, tripling my 100,000 on these dot-coms. And it was so addicting because that money, first of all, I came from a relatively, middle-class family, both my parents being teachers, and it was just addicting to see this type of fake money. And I said to myself, you know what, if this can be done, I have to pursue it. So off I went to college and I basically got involved in different things, started trading a little of my own money. And before you know it, I was out of college and I said, I've got to just go right into trading. So I only had $10,000 to my name at that point. And I went to a firm that gave me leverage and they gave me $50,000 to trade. Now that's good and bad, right? So I had money to trade, but at the same time, all losses came out of my portion. So very quickly, I lost money. I didn't know what I was doing. And I just had to basically work multiple jobs, replenish that account over and over and over again until I slowly started to learn how to read charts. And, I just basically was so dedicated to not failing that eventually I just forced it through and learned enough where I learned my lessons the hard way, really, and began to slowly become more and more profitable and then learn more and more about the charts. So that's a brief background, but it's been a great journey and it's a pleasure to be here with you.
Gareth, I have to ask you, you said that when you got the 100,000 and it was the .com and it was, doubling and tripling, did you go the other way as well? Because we all know how the .com bust happened.
Yeah. So the game that I was playing was only like for a month long. So I didn't necessarily get affected by that, but surely, I did see what happened. I was following the markets and I did have investments. I had that small account that I kind of was playing around with early on. And I certainly got stuck in some trades. In fact, a funny story, right? So I was in my dorm room at the university at college, and I had invested in this biopharmaceutical company, and all it did was go down since I bought it, which I'm sure we've all had that experience, right? But I got so frustrated, I emailed the company and I said, you know what, I'm just not happy. I'm a shareholder. And so a week later or so, I was in the communal bathroom brushing my teeth, and my roommate came out and said, hey, there's a phone call for you. And I said, mouthful of toothpaste. I said, who is this? And it was the CEO of this publicly traded company, about $1 billion company. And he had called me to reassure me. And I barely spoke. I was so in awe. But bottom line is I held that stock and eventually I got back break even, made a little bit of money, and I sold it and I was done. But it was that will never happen today. You're not going to see CEOs calling people. But back then, I guess this one did.
Well, in Australia, they tend to, especially in the small caps market, the CEOs and managing directors, like if there's a shareholder that really wants the answer to a question, they're pretty good like that down here.
That's wonderful that they do that.
It is. I want to know right now, though, as we chat today, not only are the markets very volatile, and I'm looking just going, I turn around to people and I go, you just got to be diversified, because I don't think any of us know what's happening. And I don't know, because you're looking at the trades, you're looking at charts. And I want to go into the charts a little bit. And I want to understand how much charts play a part of your investment thesis.
So charts, I would say, are about 90% of what I do, right? So I look at the macro picture, but because I'm a shorter term investor, meaning I hold for either intraday, which is day trading, or I hold for weeks or a few months, I'm very focused on the next move coming in the short term. So really, that's what I'm looking at here on the charts on the short term basis. I love having a macro view because the macro view tells you of upcoming changes in technology or other things. So I do think it's important to kind of have the bigger view as well.
So right now, with markets being as volatile as they are you all in with the markets and trading in, I guess, shorter time frames because of the volatility?
So the volatility is actually a really good thing for shorter term trading because you get these massive pops. So if you go long at support, you can make 5-10%. I mean, in the US here today, we had a huge rally with some of these big caps, even up 5 to 10%. So you can make a lot of money with the volatility. I also have swing trades that I'm holding for longer periods, but I am diversified in kind of more of a long short portfolio. So I have certain in equities, certain stocks that I really like on the long side. There's some gold stocks, GDX, which is the miners ETF. And then there's also some Chinese stocks, which I've kind of been dabbling in because they've been hammered and the valuations are very, very attractive. Then on the other side, I'm short the equity markets. So I'm short the NASDAQ, I'm short the S&P, and I'm short some of the semiconductors. They've gotten too expensive. So it's diversified with long short in mind.
You say that you're shorting the S&P. Do you think that the market's a little bit frothy at the moment?
I do. I'm in the camp where, I mean, if you look at the markets and you look at what the Federal Reserve has said here in the US, you have to start to think that the downside is getting close. And what I mean by that is the Fed has created this bubble in the US, and really it's global, right? So all central banks have printed tons of money. It's been a never-ending blank check. And finally, you're starting to see this hawkish tone and a kind of a pullback on all the money printing. And what that ends up doing is if you had the money printing letting the markets go up, it only makes sense that as you pull back on that, it's going to start to put pressure on valuations that have gotten absolutely insane. In fact, what I want to do here is let me show you this chart of the S&P 500. I think it's absolutely important to see what's going on here. So this is charting 101, folks. What you can see here is you have this beautiful channel on the S&P 500 that the market has been in for the last year and a half. And you can see we went right to the high end here, and then we sold off. And now we've pushed back up. But again, what I'm looking for and what I'm expecting is a little bit more upside, then a reversal. And eventually, as the Fed starts to tighten and taper, you're going to see a break of this lower trend line, which will be a break of the trend. And once that happens, the algos are going to start to sell heavily. The institutions are going to start to sell heavily, and we'll see a bigger drawdown in the markets. And again, it's all based on the Fed and interest rates and all this type of stuff.
Well, and I like that chart and how you explain that. And thank you for making it 101, because I'm not a trader. I invest for long term, but I think it's still relevant what you're saying, whether you're short or long term trading, because these big macro pressures, I guess, are going to affect the market. And you talk about the Fed with interest rates. Do you see them increasing at all? Because they can't increase them, can they? All they can do is keep putting that little money printing machine, just keep letting it run.
Yeah. And so this is where things get really interesting here in the US, because Jerome Powell, the Federal Reserve chair, he was just reappointed by President Biden, right? And President Biden has the midterm elections in 2022, and he's looking, right? And this is my hypothesis. Again, I don't have any proof of this, but it's kind of connecting the dots. And he's saying, okay, I'm going to reappoint Jerome Powell to the Fed position, but Jerome Powell, I need you to start to attack inflation, because a lot of the voters that are for the Democratic Party are the middle income and lower incomes who are getting hurt the most by inflation. So the idea here, at least what I'm thinking, is that in the near term, you're going to see inflation attacked a little heavier by the Fed until those midterm elections next November. And then after that, you're absolutely right. There's only so much tightening the Fed can do, because our debt is so massive that if they tighten and interest rates go up too much, we will literally go broke just making the debt payments on that of interest. So it's a fine line here. I think you get the interest rates maybe on the 10-year in the US to go to maybe 2%, 2.25%. And then I don't think the Fed can let them go any higher in the near term or in the long term.
And for those of us out there that are looking at interest rates, they could also go negative.
Yes. Yes, I mean we've seen that in many other countries, in fact. So that's the idea, is that the Fed has a reputation of slowly tightening a little, or tapering in this case, and then as soon as the next event occurs where unemployment surges, then the Fed comes out and prints more money and lowers interest rates again to stimulate the economy. And I don't think there's any way to get out of that. They've boxed themselves in now into an area where there is no out at this stage.
They've got no toys left in the toy box. And it's interesting what you said is that Biden is going to do this until the midterm elections.
Yeah.
Now,
well, that's the most important.
Is broken, isn't it, Gareth? Because that's all they're doing is they're going, well, I just want to get votes. I'm not caring about long-term economy.
And that's the biggest problem. And not to get on the political side, but this includes both parties here in the U.S., the Democrats and Republicans. The only thing the politicians care about is getting reelected in 4 or 6 or whatever years. So they're always thinking about the short term, which is why the system is so broken for the economy in the long term. And it's a sad state of affairs. I do hope that at some point it gets fixed, but I'm not hopeful at this stage.
Okay, so we've got a big investor audience out there, and they're all sitting there scratching their heads going, well, what do I do? Where do I put? How do I not only grow my wealth, but how do I protect it? So let's go into a couple of charts, and let's go more specific, if you will. I'm quite often known as that gold lady. And I want to cover, if it's okay with you, I want to cover gold, I want to cover silver. And then in the last few days, I've been talking a lot about uranium as well. So, and maybe some oil and gas, but we'll finish off, Gareth, with crypto, because there's those that are, and there's those that are not. So
right, of course.
If you've got a chart, do you have a chart on gold? I'm throwing this at him, ladies and gentlemen, very, very, this is not pre-planned. So we're doing it on the hot. Oh, well done, you. Okay.
Yes, I came prepared today.
You are good. So what is this telling us about gold? Because for the last year, I was just talking to Jim Rickards a couple of weeks ago, and I said, the last time I spoke to you a year ago, gold was at about 1850. Not much has happened in 12 months.
Right. And so this is what's amazing about this price action from a technical chart standpoint.
Yep.
People are saying, oh, gold's dead. No one wants gold anymore. Crypto, we'll talk about later, is the new thing. I'm in the opposite camp. I think gold is actually going to outperform cryptocurrencies over the next year. And what you see here is on the chart, you're right. You had this massive move up in gold from 2019 to basically almost 2021. And then since then, it's done nothing. But that's actually consolidation. That's known in the technical analysis world as bullish consolidation. And basically the analogy that I like to use is, think about a marathon runner, someone who runs a really long distance. Now that's what the chart of gold did. It ran this huge long distance to the upside. After that marathon, you can't ask the runner to go run another one right away. They need to refuel. They need to get energy back. They need to take a little bit of a rest. And the fact that gold has actually stayed in the upper ranges of this entire move is very bullish, and it sets up for a breakout potentially. And one of the lines I'm watching is this one right here. Check this one out. So you can clearly see you have a pivot high here, and you tested it recently on the gold chart, and it failed. It did not break out. What you're looking for is that to break out, which is right around 1860 or so. And when gold, and this is in US dollars, by the way, but when gold breaks above that, you should head very quickly back to about 2065 on gold US dollar. And then actually I have a projected target close to 3,000 by the end potentially of 2022. So there's a lot of upside potential here. And don't be fooled by the kind of the choppy sideways action in gold. That's actually a very good thing. The other thing I'd just like to mention, if you go back to the 1970s and the 1980s when you had massive inflation, in the early portion of the 70s, kind of the 75 to 77 range, when inflation was high, gold did nothing.
Yeah.
All right. It chopped sideways. And then in the later portions, when inflation did not come down, that's when gold really, really ripped. And it looks like you're kind of starting to repeat that same thing again.
Very, very interesting. And by the way, Gareth, music to my ears, because I am a bit of a gold person. So, and so that's interesting that you feel quite positive about that the fact that it has been in that consolidation phase for just over a year is not actually bad news, ladies and gentlemen. It's quite good news, because
quite good.
And ultimately, I guess, over a longer term. But do you trade in and out of the physical gold, or are you literally, and do you look at the ETFs and the miners, or what do you do in the gold space?
Yeah, so in general, I trade out of the GLD, which is the gold ETF here in the US. So that's kind of my in and out for shorter term positions. And then honestly, I buy physical gold. So I've accumulated physical gold. It's one of those things I kind of view as a insurance policy. So if I wake up one morning and everything's just gone to heck, right? Well, then I know I have that physical gold. If the banks are shut down, if the technology system is kind of down, I know that at least I can feed my family and do what I have to do. So it's kind of an insurance policy in that respect. Maybe I'll just pass it down to my kids at some point, but for the most part, it just gives me that sleeping easy feeling at night.
Yeah, and I think that's what we often say to people is don't look at it as an investment, look at it as an insurance policy. Let's go silver, Gareth, because there's a lot of people out there that, you know what, they're almost, it's interesting, isn't it? Because the people out there are almost angry with the silver price. They're accepting of gold, but they're almost, I read the commentary and it's like, oh, they've been saying that for 30 years. And I'm just, you know, I'd love your view on that.
Yeah, so we have to remember that it wasn't that long ago that silver had a massive spike to the upside. So what I like about that is, and silver, you know, going back to 2008 was trading at $8.65, and it ran all the way up to $50 here. So I mean, you know that it has that potential. But again, what I'd like to point out here is, look at this. This is the weekly chart of gold and of silver. Yeah. And what's great about this is you had the same sharp incline rise in price from about $12 all the way up to about $30. And then since then, you've consolidated between $20 and $30. So the same thing applies as what we were talking about on gold, is that you can literally draw trend lines here. And this one's down sloping a little here. This gives you your breakout trend line. And you can see, again, pivot high, cuts through this line, touches this one perfectly. That gives you your upside resistance level, which inevitably should get taken out. On the other side, you can actually put in a trend line with the lows, which gives you a perfect little kind of wedge pattern that silver has been trading in. Now, I do want to see silver hold this kind of 22, 21 level, because again, that is your low end of support. If it does break, you'll probably head down to this area around $18.50 to $19. But right now it hasn't done that, and it's still in a very bullish consolidation pattern on the weekly chart. So again, look at the big move up, and this is where the runner is kind of relaxing and kind of rejuvenating itself so it can make another big run to the upside. That's what I expect, at least.
It's interesting. I love that analogy of the marathon runner just needs to take a rest for a little while. So they're just having a rest, ladies and gentlemen. It's all good. It's all good in silver and gold.
And remember, I would just like to say too is, you know, you have different charts, right? So you can have a vertical chart that surges to the upside, and then it has a surge right back to the downside. That's not good. That's kind of a reversal. That's the marathon runner going backwards. You never want to go backwards fully in time. You kind of just want to take a break. You want to stay. Generally, what I look for is staying a break in the upper 25% of that initial big move up. And then that's what you would classify as being bullish consolidation.
Gareth, I've been talking a lot lately about uranium. Down here in Australia, we do have a number of uranium miners and lots of bullish commentary around uranium, including, you know, Rick Rule recently saying that he's very bullish on it. And let's face it, it is a clean carbon energy of the future. Mm-hmm. Love to see what your thoughts are on that, not only with the charts, but also your thoughts on uranium as a whole. And do you just play the spot price for uranium, or do you play the miners as well?
In general, if I'm investing in uranium, I'm again doing the ETF, and I'm using it because it's so volatile. It's a great trading vehicle. So I'm not necessarily looking at it right now as like kind of a long-term investment. It's more in and out. So I like to have the very liquid ETFs. But if you look at the uranium, this is the uranium global uranium ETF. What you can see is that price has continued to kind of hold this level right here. So again, if I put a trend line in here, see this pivot high right here? Yep. Put a trend line and just draw it right across. And you can see how you came down here, bounced right off of it, came down here again, and you're bouncing off of it again. So as long as this level holds, which is right around $23.50, then that is very solid. That gives you a good basis for the uranium price. My guess is I'm in your camp. I think uranium is part of the future in terms of solving our energy crisis with a cleaner energy. I mean, there is a risk, but it seems like they're starting to develop technologies that kind of make it a little less risky. And it's much cleaner, obviously, than fossil fuels. So I do think you have upside in uranium. I think if you have a time horizon of a couple years, you'll see a lot of upside coming into play.
Okay, so it would be remiss of me not to talk about what's going on in the digital currency world. And in fact, today here in Australia, on the news, they were talking about how Australia is going to be looking at a central bank digital currency. It's the talk of the globe at the moment. Those of us that I guess are libertarians and like to get a little bit out of the system love the crypto world and the Bitcoins and Ethereums. Is that something that you have looked at, invested in, advise your clients on? Tell me more about your views on crypto.
Yeah, so I love the future of cryptocurrency. I think there is absolutely a place for it. I also view it as a bubble right now. So I like talking about the dot-coms back in the late 90s, early 2000s. You basically are at the height of the dot-coms right now for crypto. So you need a washout. You need essentially, there's thousands of these cryptocurrencies. I think 95% of them will be worthless. The ones that survive will be like the Amazon.com here in the United States, where back in the dot-com bust, that was about a $5 stock. Now it's obviously, $3,000, $3,500. It's done amazingly well. So those will be the ones that survive will do very, very well, but you need a flush out. So for investors, I would say tread very carefully right now. To me, it looks like it's starting to break down a little bit. We've seen a big pullback after a double top. In fact, let's take a look at the Bitcoin chart here. So you can see here was your April high. And this is a very important thing. So the April high, let me put in a trend line off that April high and drag it right across. All right, so there we go. So what you can see here is you pierced it briefly and you failed. And then you pierced it again. It tried so hard. The bullish sentiment here, at least in the United States, was absolutely insane when it was breaking that $65,000 high from April 2021. And yet again, it failed. The only reason it failed with so many average investors buying into it was that you had bigger players selling. And that's never good, folks. When the big boys are selling, when the big girls are selling, it usually dictates downside, and you've seen a big corrective move. Now, recently, we've seen a good bounce here off of that flush that happened last weekend. But my guess is we're eventually heading down to 30,000 down here. And honestly, I think sub 20,000 on Bitcoin. All right. So again, if you feel like you missed the train, there's likely going to be another opportunity. And a lot of it will come from a deleveraging event that I think you're starting to see in the market a little bit because of the Fed tightening. And remember, liquidity is all connected to the Federal Reserve. As soon as they start pulling back, you're going to see the markets come down, and that will translate into kind of a deleveraging in the cryptocurrency world as well.
Gareth, it's interesting with that and with, because that was Bitcoin. And we know it's volatile. It's come off about 30%. You're saying it's going to go even further. There's people out there that are saying that governments could, in effect, ban any sort of crypto, trading, investing, whatever way you want to look at it, because they're saying, well, we're here to protect the people, which I find quite amusing. Do you think that's possible? And do you think that it because of that, people should be even more cautious?
I think it has to do with where you live. Obviously, China has been very harsh on banning cryptocurrencies and mining even. But at least here in the US, what we're seeing is that a lot of the mining operations that were going on in China have now come to like Texas.
Yes.
And that's actually a very positive thing for the long-term stability of Bitcoin and cryptocurrencies, because there's so many jobs now that are associated with blockchain and cryptocurrencies. So I'm very hopeful that that doesn't happen, at least here in the United States. But I do think you have to look at, your individual governments where you reside in the world and kind of look at that to see. Ultimately, just to be clear, even though I think Bitcoin has to have a deleveraging event down along with the rest of the cryptos, I'm long-term very bullish on Bitcoin. I think it's the digital gold. And I do think you see 100,000, maybe 3 or 4 years from now, and then 500,000 eventually.
In my lifetime, Gareth?
Yeah, considering the moves it makes, if you think about Bitcoin, it hit, I think it was like 1,200 in 2013, 20,000 in 2017. 68,000 in 2021. If you just extrapolate every 4 years, and by the way, that's an amazing thing on a technical basis. Bitcoin was formed or created in 2019. 4 years later was 2013's high.
Hang on, Bitcoin was created in 2009, not 19.
I apologize. 2009, it was created. I apologize. Then 2013, 4 years later, was the high blow off top. Then 4 years later, 2017 was the blow off top. And now you're looking at 4 years later at 2021, which could be another blow off top before kind of what they call a crypto winter, if you will. So it seems like it has 4-year cycles, which gives you a good basis that you probably get a good buying opportunity, hopefully down around 20,000 in the next 2 years before the next kind of grind up takes place in the latter 2 years to the new highs.
I just wish it would continue to do what it's doing. Do you look at oil and gas? Given we've had COP21 and all of this talk about, I guess, a clean energy future and zero carbon emissions, are you staying away from oil and gas? Now, we've got, obviously here in Australia, there's a lot of oil and gas companies down here and you know, a lot of people that look at that as a sector, but the sector itself has been pretty lackluster over the past couple of years. I'd love your views on that.
Yeah, so I do trade oil and gas. I was recently short oil and then it collapsed and then I got long oil. I got out too early, honestly, but I got some nice gains on that as well. The trade, and I'm glad you asked about this because there's a great swing trade opportunity in the natural gas chart here. And this is the natural gas chart. And I want to just show this. So take a look back in 2018, this high. There's a little pivot right here, connected through here. And then look how this price retested that line, rallied. And this is where we got that massive rally here in the US. And I know globally there were shortages and everything like that on natural gas. But look at how natural gas has collapsed right back to that line, which is right around $3.60 here. That to me is a great opportunity on a pure technical basis for a potential bounce, at least back to, I would say, $4.25, $4.50. So really a kind of an interesting opportunity there. Again, longer term, if you said, you know, I want to invest in oil for the next 50 years, I would probably say I wouldn't do it. I do think clean energy is eventually going to push it out. But as a trading vehicle, this volatility just gives you so many great opportunities.
Gareth, I love the charts and I love the way you look at that sort of thing. What advice would you give to people? Now, not everybody watches. We have subscribers from all over the world, and a lot of them invest more for the long term. Obviously, some are traders. What advice would you give to people right now? Is diversification the key? Is trading the key? Because for me, it's all about how do we grow and protect our wealth in volatile times.
Right. And that's really the essence of it, is you need to grow it, and it's better to grow it slowly and protect than go all in and lose, right? Which is what a lot of people unfortunately do. So I think what you have to look at is the longer term trends, right? So we know at least the Fed is beginning to tighten. We know that inflation is starting to rear its ugly head. That gives you kind of that bias towards gold and commodities. Mainly, I would say the metals more than the oil and gas area for me personally. And I think, again, you have to say to yourself, okay, you know, at least here in the US, money has flown into stocks here in the US at a record pace. Everyone wants to be in the US because we had the best Fed, and, you know, the economy has always been so resilient. But I do think as the Fed starts to tighten, money is going to start looking for other countries to invest in. And I like, you know, South America. Companies there are very interesting to me. Brazil, they've been hammered. Some of their stuff has really been hammered. And I honestly think even with the risks of regulation, some of the Chinese stocks, you know, small positions there, diversified, could be very, very interesting as well. So, you know, again, I would say make sure to diversify out. Yes?
Sorry to interrupt you. China, isn't that very risky given the jurisdiction?
It sure is. Absolutely. Right. So for instance, if we look at here, let me bring up like an Alibaba chart here. And Alibaba has absolutely been crushed recently. Yeah. Take a look at this chart. I mean, it's trading back to levels going back to, I mean, you could go back all the way to 2014, and this is where it was basically trading at this same level. So you're right, that is risky. So you have to, if you're going to invest, you have to be aware of what percentage of your portfolio you're looking to invest in. I say stay with 1%, 2% in a couple of these names, and just kind of understand that the valuations makes sense at these levels. The regulation is a risk, but keep in mind, in my opinion, and this is just my opinion, the Chinese government doesn't want to torpedo their own companies, right? I mean, and what's going on here is if their prices keep going down, then these companies have debts that they can't finance, they can't pay off their debts, and it actually could cause an issue for their economy. So I'm in the camp that the Chinese government is trying to rein in monopolies, trying to rein in kind of certain practices and make sure that they have control of their companies. But at the same time, they want their companies to flourish. So again, that's kind of just my take. But again, it's very important that you diversify very, very well.
Do you like Alibaba from a long term? So for me, I'm not a trader, I'm an investor. And looking at that chart, it looks to me like that could be actually a good longer term investment in Alibaba, given that it's back to its 2014 lows, highs.
So that's how I'm actually viewing it. Is I actually have a position in it, and I'm more than willing to hold it for years at this point, which is somewhat rare for me. And the idea being is, again, it's a small percentage, but if you think about how many people, right? So there's 1.5 billion Chinese, and then I compare it to Amazon, right? And Amazon, yes, it's kind of expanded outside the U.S., but it has 350 million here in the U.S. that it goes to. So the market for Alibaba is so much bigger. And it's trading at, percentage, 20% or less of the valuation of an Amazon. And then again, you have to look at, the profitability potential there and so forth. So yeah, I think if you have that ability to stomach kind of the short-term regulation fears, and with the discounted price, it makes sense to me that, yeah, you could tuck this away and it could end up being the next $1-2 trillion company like Amazon.
There you go, ladies and gentlemen. There you heard it. That's the tip of the day. Alibaba is what Gareth reckons. But you know what? As we always say, do your own research. Now, Gareth, we're running out of time. What would you say? I want so everyone knows I asked for 3 reasons. Let's go for 3 reasons. What's your three pieces of advice that you would give investors right now in this, as we're coming into Christmas? Give them 3 little Christmas present pieces of advice.
Trade and invest with logic, not with fear of missing out. FOMO is a term that's used. It is almost always going to get you into trouble. Look at buying stocks the same way you buy something at the mall or the supermarket. You buy things when they're on sale. You don't pay up for them, right? You use that in your investing ways, and you'll be much better off for it. The other ones would be, that's a good one. I would say tuck that gold away. Another one would be definitely pick up a little bit of gold. It definitely has that upside. And the beautiful thing about gold is it's not super, super volatile. I don't think it's a really risky play at these levels. And with inflation growing and the inability for the Fed here in the US and really globally to really not print more money at some point in the future, that means gold should go up based on more dollars in the system. And lastly, have a smile on your face, enjoy life. Life is short. Don't get too stressed out. It is money, but again, it's only money. And if you have your health, you have wealth.
What a fantastic way to finish, ladies and gentlemen. Gareth, what an absolute pleasure it's been chatting with you today from Florida. I wish you and your family all the best for a fabulous Christmas, lots of happy trading days, and let's get you back in the new year to see what 2022 might bring us. But as he said, ladies and gentlemen, really important, use logic, not fear of missing out. And remember, buy on sale, not when it's at full price. Gareth Soloway from inthemoneystocks.com. Thank you so much for joining us on Small Caps today.
Thank you so much for having me, Carrie. It was a true pleasure.